My name is Jamin Gurker. I'm an associate real estate broker in the state of Alaska, and my mission, as always, is to help you to build an intentional and significant legacy for yourself and your family by coaching you and your family in real estate. And today, I'm going to do some of just that, which is kind of educating as far as what real estate is, the benefits, the downsides, all that good stuff. And I'm going to break it down really to about a teenage level. So if you have anyone in your family that kind of fits that, maybe they're talking about real estate, maybe you just want them to be aware of the tools and the power that real estate has in order to help them in the future. And you're trying to make sure that they don't get bamboozled by a lot of the moronic advice they're getting on TikTok and other places about real estate, then this is going to be a good video for them and a good video for you to refer them to. Now, before we get into all this, feel free to give me a like, subscribe, do all that good stuff. And if you have any other insights, any thoughts like that, feel free to drop them in the comment section down below. And we'll try to make this a good little resource for teenagers as they're trying to figure out real estate and how to use it in the future. Or, I don't know, maybe now. All right, but let's go and jump into today's video though. All right, now first off, the good thing about real estate is it's kind of like an investment that you get to live in. You know, when you're investing in the stock market, it's going to be turning off money. It's going to be making you some kind of a return for the money you put into it. You put, for the sake of numbers, I put $1,000 into the stock market and it made me $100. Okay, great. That's awesome. And that still gives me $100 and I don't have anywhere to live. Whereas with real estate, you buy it and you're actually paying the mortgage on a monthly basis. It's continuing to go up in value and you also get to live there. And that's really what makes real estate so unique. And there's definitely a lot more scarcity with real estate because there's a finite amount of space that we can build on and resources to actually build those homes with. That's going to be one of the big differences. Now, let's go and talk about some more of the benefits real quick here. Okay, if you are moving out of the house, one of the biggest things you're going to find out pretty quickly is your cost of lodging. In other words, the rent you're going to be paying has a real chance of going up and up and up as soon as you take out a lease somewhere. You know, your leases are usually only good for about 6 months to a year, at which point the landlord can, unless you're living somewhere that has rent controls, which that's a whole other issue of things you're going to run into. But in most places, the landlord does have the option to increase your rent. Now, they're not doing this maliciously. Usually it's because insurance has gone up, property taxes have gone up, maintenance has gone up, utilities have gone up for one reason or the other. So there's any number of reasons. The landlord's usually just not trying to fleece you for all you're worth. But big thing for you though is when you're first moving out, the cost of housing, which is going to be your biggest, most expensive thing you're going to have in your entire budget, it has a bit of a question mark on it because you're pretty sure it's not going to just shoot up, but you're not guaranteed that. And so that's the reason that buying a house gives you a lot of stability, because once you buy the mortgage and everything, like it's locked in for like, let's say $1,600 a month, it's locked in for $1,600 a month for like the duration of the loan. And there's going to be some fluctuations in there. Yes, because of property taxes and insurance that might happen. But by and large, it's going to stay about the same. And that's one of the biggest advantages you can have. Think about it this way. If you had somebody who bought a property 20 years ago and they're still paying like $900 a month for their mortgage, you can imagine how much of a benefit that's going to be to them, not only now, but you know, how much benefit that has given them up to this point. You know, so imagine how much of a benefit you're going to have paying, you know, 2024 prices and mortgages and everything for something in 2020 and 2050. So you can see how big of an advantage it gives you just keeping that one line item in your budget stable. Now, the next thing that really does benefit you is the cost of your house predictably goes up. Now, there's going to be ups and there's going to be downs, and you have to maintain the property and all that. But by and large, as a principle, the value of real estate goes up and up and up. In recorded history, I think there's only been 2 small instances where it went backwards, and that was in the crash in 2009. And yeah, 2009. And then it did rebound actually fairly quickly after that. The big thing you want to be looking for is just find something that's a real nice meat and potatoes. Everyone's going to want a house like this, and then maintain it. And that's kind of the ideal scenario. Maintain that property, and then its value does predictably go up and up. Now, you're not going to be getting rich overnight. This is a slow and steady wins the race kind of a strategy, but it does put you well on that path. Now, something else that really does help you when you're looking at buying real estate is there are a lot of tax advantages being a homeowner. I'm not going to get into the specifics here, but yes, you do get tax breaks for owning a property, for maintenance. You get depreciation for the property because they're assuming, okay, well, the property is going to be breaking down over time, so we're going to be decreasing the rate that we're going to be taxing you. I think that's just called depreciation, the asset or obsolescence or something like that. I don't know. I'm not a CPA. Go find that out. But the big thing is you do get tax breaks for owning real estate that you do not get as a renter. So that's another reason to really be looking at real estate as soon as you can. All right, the fourth big benefit I can think of if you are looking at buying real estate is you control your own destiny when you own the property. The landlord is not going to be increasing your rent every 6 months to a year, and you're going to be able to decide what you want to do with the property. Like, do you want to put a hot tub in the master bedroom? Guess what? You can do that, provided structurally you can handle it and all that good stuff. If you want to build a fence in the backyard, you can do that. If you want to update and remodel the entire kitchen, knock yourself out. You control the destiny because you're the boss of that house. And that's, obviously a really big deal, and that's an incredible responsibility, but it also does have a ton of benefits to you because you get to actually control your own destiny and have a vision for the property and actually do it. All right, now let's talk about some of the downsides to you of owning a property. Number one, it is a lot more expensive upfront to buy a house and maintain it than you're going to have as a tenant. For example, if you're looking at buying a house, you're not usually looking at like hundreds of thousands or anything like that, but you are probably looking, even with a lot of programs out there designed to keep the expenses low, we'll just say like $10,000 as an example. So it's going to be, let's just say as an example, about $10,000 in closing expenses and all this stuff with some programs in order to get into a house. And then you got to maintain this thing and have the yearly maintenance. Mechanics go out and like check all the heating systems and all that. There's a leak. Okay, well, now we got to fix that. We got to fix that quick, or else that turns into like easily repair project in the tens of thousands. So it's a lot more expensive than it is to just be a tenant. You sleep a lot easier when you're a tenant just because, something breaks down. Not your circus, not your monkeys. Another downside of this is that you are, and this doesn't have to be a downside, this doesn't have to be you, but a lot of people, when they go and they purchase a property, they watch the real estate market obsessively. And I actually don't recommend this because you don't watch your portfolio obsessively once you invest in the stock market. And you shouldn't also be obsessively watching the real estate market as well just to see what it's doing. You want to check in maybe every year or so, maybe every 6 months or so, just to kind of get a feel for what's going on. But unless you are actively looking at moving in the near future, there's really no benefit to checking in regularly. Now, I have to check in every month just because I do my market updates, but that's excessive if I was just trying to keep a feel for what's going on in the market. I guess you could. I don't know. I kind of steer away from the philosophy of watching it obsessively every month because it's a slow process, and I just want to check in every now and then just to see how it's doing. I don't want to get so obsessed that I change course trying to be too smarter than I am and screw the whole thing up. So slow and steady wins the race. All right, so that's the basic ins and outs of what it looks like to own a property. Now I'm going to give you some definitions. Well, not really definitions. I'm going to explain what some basic terms are that you're going to hear thrown around in real estate, and people are just going to assume that everyone knows what you're talking about, or everyone's going to assume that you know what they're talking about, and I'm going to just make this really simple here. So number one, equity. Equity is the amount of money that you would make if you sold the property today. And how you get equity is you pay down the mortgage as fast as possible. So in other words, let's just say I bought a property for about $300,000, okay? I have gone and paid the mortgage down by about $50,000. So the existing mortgage on the property is about $250,000. All things even, let's just say I sell the property tomorrow. It's appreciated a little bit. The value has gone up a little bit because what we said before, like the value predictably goes up and up and up. I'll just say it's gone up about $30,000. It's now worth $330,000. Okay, if I sell it tomorrow, then that means that, what is that? $50,000 plus $30,000. My equity is $80,000. Okay, that is what that's what equity is. And that's why you're going to hear, you see a lot of homeowners get a little dreamy-eyed whenever they start talking about equity. Or, I don't know, maybe teary-eyed, depending on the situation. Secondly, mortgage. Okay, what a mortgage is. This one's really basic. When you're buying a house, it's assumed you're not just showing up with cash for like $400,000, $300,000 to buy the property. Most people are going to be going to the lender or mortgage company and taking out a loan that's got terms, it's got the loan rate, it's got a bunch of other stuff in there that's disclosed to you up front saying how much you're going to be paying per month, and it's also going to have a lot of clauses in there saying essentially no pay, no stay. In other words, you stop paying, we're going to kick you out, and the house belongs to the bank at that point. So that's what a mortgage is. All right, another thing you're going to hear fairly often is the deed. So what a deed is this is the legal instrument by which ownership is transferred from one owner to the other owner. Now, in a deed, it's also going to be very specific about what kind of rights are being transferred and what guarantees are being transferred as well. So in other words, if I'm transferring quitclaim deed, all that means is, okay, I'm transferring all the rights I have to the property, if any, to this person over here. Now, let's not, let's not get too in the weeds here, okay? The big thing is a deed just says how the property is going to be getting transferred from the seller to the buyer, okay? That's what a deed is. When they say you own the deed for the property, that just means you own the property. All right, now the next thing is going to be home insurance. Now, home insurance is going to be required by the lender, okay? You don't get the option to just not have home insurance unless you're using cash. Home insurance it kind of depends on what kind of policy you get. Obviously, I'm not really in the insurance game. You're going to have to go talk to somebody about that. I've got people I can recommend, but the big thing as far as the insurance goes is you got to have it. If something big happens, you want to make sure that the tree falls down on the property, that it's going to be the insurance company paying the $50,000 to repair it and not you. And that's really going to be the big thing, that they are going to be paying for any big repairs, any big accidents that happen to the property. That's going to be coming out of their pocket. Now, you have to be very careful and watch for the terms in there. They're going to have stuff like, you have to maintain the property at all times at 55 degrees. You have to do this, you have to do that. So go through there, make sure you really understand what you need to do, because those little clauses there are built in so they can kind of weasel their way out of something if something does come up. In other words, if let's just say like the pipes freeze and break in the property, and now they can go and just say, well, you were out of town, you were going to save some money, you turn the temperature down to like 50 degrees, and the temperature is supposed to be 55 at all times, therefore, we don't have to pay anything. So that's something you have to be very careful of if you're a homeowner. So just make sure you have a good talk with whoever your insurance agent is, and you know what the requirements are, so you avoid a situation like that where suddenly you're just up a creek without a paddle. Now, what a home warranty is, though, and this is completely different from home insurance. Home insurance protects you against like a big catastrophic accident. Like it's just a mishap. There was a fire, like the roof collapsed due to a lot of snow that suddenly piled up, just stuff like that. I don't know. Maybe they wouldn't cover that. I don't know. Talk to an insurance agent. But what a home warranty does is it looks at the specific appliances within the house, in like the heating system and maybe some plumbing and appliances. And it says, okay, if this stuff breaks down just because it's old and it wears out, then we'll go ahead and have you do a service call where you call them. It's like $100, and they come and let's just say the furnace went out. They come and they replace the furnace. Okay, and that usually would be a couple $1,000. Now, home warranty is really nice, at least for the first year you own the property, just because if there is going to be any breakdown in the appliances and the heating or plumbing of the property, it's going to be within the first couple of weeks. So that's why a home warranty is nice. Most people decide not to get a home warranty necessarily the entire time they own the property. It is nice to have, but not exactly necessary as home insurance is. Not exactly required, I should say. All right, you're going to see the term assessed value thrown around too. Now, assessed value is different from the appraised value for the property. And the difference is up here in Alaska, the assessed value only means that's how much the town, borough, whatever is going to be taxing you for the property. Because, welcome to the club. You're a property owner now. You pay taxes on that. And we can complain about that all day long, but the reality is everyone's going to be paying some property taxes. And how they determine that is they have to first determine the value of the property. If they say it's a $400,000 property, then you're going to be paying a percentage of whatever that value is. If they say suddenly your property is worth $500,000, then now you're paying a percentage based off of $500,000. So the assessed value is just that value that the tax man thinks that property is now worth. Now, the appraised value is whatever the value is that the appraiser says the property is worth during the transaction. So if we buy a property for, let's say, $300,000. In the transaction, the lender hires an appraiser to go out, evaluate the property, and make sure that the lender is not overextending themselves and offering more money than the property is actually worth. If the property is only worth about $300,000 and the lender, makes a loan for $400,000, like they're upside down from day one. So the appraiser is there to really be an impartial third party that comes in, looks at the property and says, whoa, hold on, guys. Like, this property is about $100,000 less in value than what you guys offered, and this is what I think you should pay instead. Like, that's what an appraiser does. So the appraised value is just whatever the appraiser says the property is worth. And we can really get weeded there, but let's just keep it simple. All right, we're gonna take a quick break here. For those of you who are considering moving to Alaska, I do have a podcast for those of you who might be interested in just hearing from people who have actually lived here for a little bit, even if it's just a couple months, and they can kind of share their perspective, their likes, their dislikes, how they got to Alaska, their entire story. That's something that would benefit you. Make sure you go check that out in the description section down below. Now, let's go and finish up today's video looking at some of the myths and myths that you're going to find if you are looking at purchasing real estate. All right, probably one of the biggest myths you are going to hear if you're a young person is the market is going to collapse. It is just a matter of time, and then we can jump in and we'll get our own. Talk to your parents about that, but the reality is they could tell you people have been projecting the market's going to collapse for decades at this point. There's a lot of people out there who like doing that, and the reason is that eventually they're going to be correct. There's going to be a slowdown in the market one way or the other. That's just how these open market capitalist systems work. Eventually there's going to be a slowdown. There's going to be a bit of a reversal, and then it gets right back to going up and up and up. So there's really not a projected time where there's going to be any kind of these reversals. Nobody really knows for sure when that's going to happen. It's going to happen eventually, but the reality is these things ebb and flow. It's not a surprise. Let yourself be the one that's calm and collected when everyone else is freaking out, because they're gonna see something in the news saying the market's collapsing. They're gonna sell immediately, and then they find out a couple months later, oh shoot, it actually wasn't that bad. Like, we already started increasing again for the value of the property, and shoot, the house is gone now. So that's what we're trying to avoid. Okay, the reality is that market collapses only happen when there's a lot of inventory, and there's the exact opposite problem now. There's actually a shortage of inventory, so there's really not a foreseeable way that we would have a market correction and having a big crash anytime in the near future. So that's myth number one. Second myth that you're going to see is, real estate is just way too expensive. I could never get into it. This is something that was available to my parents and grandparents. It's not something that I can do. The reality is you have to put down much less percentage-wise for a house than your parents did. And yes, I do know that the average cost, blah, 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 is higher now than it was then. And also, there are a lot of programs where you don't have to put down 10, 20% anymore. There are some programs where you don't even necessarily have to put anything down. Now, there are some good reasons I would caution against that, and we can talk about that at a future time. But, just know, yes, it is expensive, and if you're really focused and this is something you want to do, you can make it happen. And just playing victim is not going to get you anywhere. That kind of brings me to the next myth, and that is putting no money down is the best strategy. I do not like this one bit. And the reason why is because if there is even a little hiccup in the market when you've put absolutely nothing down, you are up to your eyeballs and leveraged like debt at that point. If it was a $300,000 properties, you took out a $300 loan. The second there's like a dip in the market where suddenly the property, just lost like $20,000, $30,000 in value, like you're upside down, you're not going anywhere. Like you're not going to get kicked out of the house, but if you do need to sell the property and move for some reason, like you're going to be writing a check at the closing table. So that's why I don't like doing that. It just every time you increase rate that you're borrowing, like your risk goes up that much. And being able to be a good homeowner is just being able to manage the amount of risk that you're taking on. Let the people on TikTok go do their thing and take on an enormous amount of risk. You just have a slow and steady wins the race mentality, because those people are going to burn out pretty quickly, because eventually the other shoe drops and it's not pretty. Okay, this is something that you're going to win over decades, not over a couple of years. The next thing is assuming foreclosures are always the best deals. Now, no, foreclosures are not always the best deal. What a foreclosure is it says, okay, you're one of those people, you couldn't keep up the debt or keep up with the loan on the property, you couldn't keep up with the mortgage, and you just stopped paying it, and now it goes back to the bank, and the bank is trying to sell it. Just because it's a foreclosure does not necessarily mean that it's a good deal. It doesn't mean you've done something really sophisticated by going and finding a foreclosure. Okay, sometimes, yes, but they're going to be a ton of work. And I always tell people, hey, you're probably going to cry at least once before we close on this foreclosure, and that's just the way that it goes. All right, last but not least, the last myth is that the cheapest house is the best house. Oh boy, this is definitely not always the case. Matter of fact, I would say rarely is it the case that the cheapest house is going to be the best house, because you get what you pay for, and yes, you did pay about $50,000 less than what everyone else did pay for, but it's got so many issues involved with it that it's just, you just keep pulling the string, and there's just more and more issues that keep coming up the more you get into this place. And even if you're handy, it's taking up a lot of brain power, a lot of your spare time, and instead of being able to do things that are actually going to improve the property, you're instead stuck taking care of the basic health and safety stuff, like, oh, there's a crawl space needs to be resupported, or there's something wrong with the roof now, or something's wrong with the piping in this place, now we have to bring a plumber in. Like, there's just pick a good solid house that aesthetically needs some work, and that's going to be your biggest return on investment, your biggest ROI. All right, now let's just say, okay, I'm sold, I'm a teenager, but I do eventually want to get into real estate. What are some things that I should do? Or better yet, when do I know I should not be looking for properties anytime in the near future? Well, one of the biggest things is if you have a ton of debt, that is not going to help you to buy a property. I know there's a lot of people who are like, oh, you got to improve your credit, you got to go get debt. No. Okay, small amounts of debt, because any amount that you pay towards debt is considered a liability on your total assets. In other words, if you are spending, well, let's just say $300 a month servicing debt, that is $300 that is seen as a negative on your total balance and what you can afford. So it actually comes back to bite you. Just having a good credit score is not enough to overcome the weight of having a bunch of bad debt that's dragging you down. Number two, if you just cannot afford the payments at all for the mortgage once it's all said and done. If the mortgage payments are more than, we'll say, about 25, 30% around-ish of whatever your your regular take-home pay is going to be, you might want to start looking at something a little cheaper. Number 3, if you are exclusively taking advice from a lot of people on TikTok who may or may not have a clue what they're actually talking about and haven't actually worked in the real estate industry at all. Number 4, if you are not really calculating how risky real estate can be. A lot of people, when they're jumping into real estate, they just have no sense of risk whatsoever, and usually this comes in the way of taking on a bigger project than they can actually take care of, or they end up jumping into a property and leveraging themselves up to their eyeballs. In other words, taking a loan out for the full amount of the loan and not putting any down payment down whatsoever. And they don't see that as risk. And that's really when you start running into danger. So yeah, not having any sense of risk is a big one. Last but not least, if you do not plan on staying in an area for at least a couple of years, probably should not be looking at purchasing any real estate. Now, the reason for this is a number of reasons. Number 1, most people are not coming in with any kind of a large down payment, which means you don't have a great equity position on most homes when you're purchasing them. Now, what this means for you is if you come in, you buy a house, let's say like little percent down or nothing, what that means at that point is your equity position is not great, which means if you don't stay there for minimum like 3, 4, 5 years, you're not going to have enough time to actually buy down the equity position in the property so you can actually move and not end up actually paying money at the time of actually selling and recording the property. So that's really the reason that if you're looking at purchasing a property, I'm going to ask, hey, how long do you plan on living here? Okay, because if you're only going to be here for a year, 2 years, something like that, I might actually urge you to go look at finding some kind of a rental property instead. Like if you're trying the area out and you're not sure you want to be here long term or really anywhere, then yeah, that really something has to be said for renting, because yeah, for real estate to work, it's a long-term play, and if you're just playing a short-term game, you kind of end up getting the worst of both worlds. So yeah, this has been my video. I'm talking about the real estate facts for those of you who are looking at jumping into real estate yourself. And if you do have any other questions, feel free to reach out to me, and I would love to be your coach and kind of teaching you about real estate moving forward. So thanks for watching. We'll see you next time.